Hi, Charlie Mattingly here with Leading Edge Financial Planning. I just wanted to share a thought with you today that we learned after last year. The difference of investments last year, different types of investment categories was larger than normal. In fact, for example, U.S. large companies did so much better than U.S. large value. I think it was unprecedented. The difference in performance was amazing. So if you were a diversified investor, you had large value, let's say you had small companies, emerging market, international, you had a pretty good year, but not as good as the year that your friend had that had nothing but large growth. It was unbelievable. In fact, some of them I've heard returns of 30 to 40, 50%, some of these large growth mutual funds. So the question we got was, have I missed out forever? I'm trying to save for retirement. I'm trying to build my nest egg. Now I've missed out on those returns. They're not coming back for me because I was a diversified investor. Well, first of all, let me quote one of our favorite Warren Buffett quotes. As an investor, you get something out of all the deadly sins except for envy. He goes on to say, if you're picking a sin, go with something like lust or gluttony. That way, at least you'll have something to remember the weekend for. Now, that's kind of funny and silly and stupid, but it's true when it comes to investing. If we look at someone else's returns, it's very difficult to go, hey, I should have had that. I could have had that. But back to the question, did we miss out forever? And let's talk about that. Really what we're talking about here is diversification. So now this is a great piece that BlackRock has put out. What does diversification look like? Why does it hurt so bad? Well, from 2000 to 2002, and oh, by the way, this was published in December of 2017, so it's nothing different. There's always been this issue of I'm diversified and there's another asset class out there that's doing way better than me. So that's difficult, but it's always there. So let's look at the money. If I invested money in the beginning of 2000, how did I perform versus the S&P 500 index? And from 2000 to 2002, diversification paid off. For the rest of the time, though, I don't know. 2003 to 2007, I should have just gone into the S&P 500 index. I could have done better. And then 2008, yeah, diversification helped somewhat. 2009 to 2017, and in fact, if we were to extrapolate this on, it's still happening. A diversified portfolio is terrible compared to the S&P. Why don't you just invest in the S&P 500? However, here's the story. If you're a long-term investor, being diversified pays off. It doesn't feel like it at the times. In fact, it feels like this. I lost money. I should have made more. I lost money. I didn't make as much as I could have. We will almost always have those feelings. So let's take a look real quick at what it looks like. What did it look like last year to be a diversified investor? This is some software that we use. I have 3 investments pulled up: small cap value, Vanguard 500 index, and a Schwab large cap growth. These are just basically indexes that show these. If you're a diversified investor, you would own all 3 of these. However, what if I just owned growth last year? Look at that. It's incredible. And this is what I was talking about. The difference in returns of these asset classes was almost unprecedented. So did I miss out forever on these returns if I should have been in growth? So now let's take a look, and let's take a look at the last 365 days. Did anything change? What about the money that I would have earned? Well, as it turns out, it does pay off to own the other asset classes. As you can see, now we're looking at the most recent 365 days. And lo and behold, one of the asset classes that did the worst last year now is doing the best. However, it feels terrible sometimes, especially when you look at a certain investment, a certain stock, a certain style of investing that's doing better. That will always be there. Boring as that is, it's like watching paint dry, and it's especially difficult when your friend or your neighbor is enjoying the high-flying returns of a growth year like we had last year, and you feel like you're missing out. You're not missing out. Stick with your diversification. Stick with your plan. Don't try to chase investment returns, and you will be prepared for retirement, and you will do great. Hopefully this helps. Please reach out anytime. LeadingEdgePlanning.com is our website. We're on Facebook. We're on LinkedIn. Charlie at Leading Edge Planning is my email. We'd love to hear from you. Thank you very much.